Well, everybody, now that we're here, it's supposed to be interactive. It's supposed to be fun. We all dig in. We try to get this done in 50 minutes or so. We have 10 minutes afterwards. We just talk really openly about anything, and that's kind of have fun time. But for now, Itai, I'm turning it over to you. You've got control of the screen. Do you want to take it for the whole crowd?
I'll take it. Thank you.
All right. Don't heckle him too hard, Rob.
So thank you for the wonderful intro. So, you know, we can talk about the election, we can talk about the news and all this kind of stuff. So I just wanted to bring in a bunch of stuff that I found to be interesting that's not really talked about so much in the news, all the, you know, you can find online, everything else. So I just want to bring it to you. So feel free to ask questions at any time, and let me hop into it. Can you see the screen?
Itai, we can see it, and we all know that you still have not yet paid for
Dude, I don't know what's going on with Microsoft. I've had this for 6 months and it still lets me do it. So until they block me and prevent me from running it, I'm still going to do it.
We know, Itai. It's only $7.57 a month. I see my credit card statement. Maybe one day you'll have enough from your investments to actually pay for it.
Sure. I think the Microsoft Corporation will do fine without my $7 a month. So we're Equilibrium Ventures, as Jeremy mentioned. We're a Texas-based RIA focusing primarily on alts. We do a lot of private market investing, but we also have a lot of public market exposure via certain and various strategies that focus on hedge ways of investing. So let's just hop right into it. So last time we talked about the VIX, or the volatility index, and we looked at, based on historical data, where we were right here at the election. We said, well, you know what? There's two things that can happen when the VIX kind of hits that 40 area. It either goes into a full-blown financial crisis, where I think about where we were last time, about 97% of all readings about that level happen during the financial crisis, or it's going to revert very sharply to the mean, because at the end of the day, the markets normally crash over an unknown, not the election, which was a known unknown. So the market pretty much followed that pattern, and the VIX got smashed from that 40 area, and now it's back to around the 20 area. And some traders will notice that it filled that gap over here from the beginning of the year during the COVID crash. So let's talk a little bit about the term structure of the VIX. I'll remind everybody, contango is a situation where future prices are trading above the current price. The VIX is normally trading in contango because the longer the time period, there's more time for events of uncertainty to happen. So therefore, the term structure of the VIX normally follows this contango kind of pattern. So here in light blue, you have the short-term contango, which is the first and second month. And then the dark blue is the longer-term contango, is the 4 and 7 month. And here in red is the zero line, where above it is contango. You can see most years are above it. And below it is actually backwardation, where uncertainty is much higher. And we've seen a lot of normalization happening post the election. But at the same time, the VIX term structure is still relatively flat for the longer time frame, which means the VIX market still projects a fair, great amount of uncertainty over the 4 to 7 month time frame. It's also worth note that now in Q4, the correlation between VIX and the S&P has somewhat normalized, as it's broken off quite a bit. So as the market has made new highs, that you see here in the x-axis is S&P 500 prices, and in the y-axis we have the VIX itself. So as the market's gone higher, the VIX has somewhat trended down, but it is worth to note that the level of the VIX compared to an all-time high is still very, very elevated. So basically what this chart measures is what's the VIX level compared to the S&P at an all-time high. And the all-time highs through 2013 to 2019, or even early 2020, were at a very low VIX regime. And now 2020, even though we're making new highs, is at a much higher volatility regime. It's much more reminiscent of the 1999-2000, 98 market, than it is the 2013 to 2019 market. So even though we're yeah, I'm sorry, Jerry.
Oh no, it's also interesting to note too that 2007 is over that line. So it kind of like looks at, hey, like in areas right before there have been crashes in the recent history, this type of these VIX levels are kind of where things are happening at.
Well, just telling you that, you know, the smooth ride of 2013 to 2019 with kind of like a grind up market is not exactly what we're seeing in 2020, as even though we're at all-time highs, volatility levels are significantly higher.
Makes sense.
So at the same time, the Dow actually had the best month since 1987 this month. And I saw today that the MSCI World Index actually had the best month ever. I think it was up about 11%, which if you're looking at the Dow, you have to go back all the way to 1987 to find better performance, which, you know, if you told me at the beginning of the year that businesses are going to be shut down or partially working, millions of people would be laid off, and everything that happened, and you told me, and the market's going to all-time highs and performing really well, you'd think you're crazy. But that's probably because you wouldn't take into account this Fed balance sheet, as we're seeing here in blue. So macro data, this is the bottom of the market right there. Macro data for the US economy here in red, S&P 500 chart here in green, and the balance sheet of the central banks.
What's the big takeaway here? That basically, as the balance sheet grows for the government, that so does the S&P.
Right. So if you remember, about 6 months ago, we had a call here where we talked extensively about the Fed's impact in financial markets, and we even brought a guy who trades based on the Fed balance sheet, and we've showed a very strong correlation of stock prices to the Fed balance sheet. And it's just kind of a follow-up to say that, you know, it's still working, and at the end of the day, markets are still following all this liquidity.
Cool.
So let's talk about this kind of interesting market that we have in 2020. S&P 500 here in blue, hedge fund index in red. These are the pros, right? And Robinhooders here in black. So if you're a Robinhood trader, you've done better than all the hedge fund managers and the S&P 500, and you've absolutely crushed it. So go for you. It's been a truly insane market.
You got a promo code? I'll sign up.
You know, I think it was the CEO of Robinhood that gave this interview and says that after the stimulus check came in, he saw a bunch of $1,200 accounts opening up. So anyways, that's just a different kind of trader that didn't have exposure to the stock market before. And that's really changing up things quite a bit. And we've talked about the Robinhood market in the past as well.
Yep.
So what it's causing, growth versus value, it's pretty insane. The Russell growth is absolutely going bonkers, where the Russell value has essentially stayed flat going back all the way to, I believe, 2016 election. Hasn't done anything for about 4 years. So that's kind of crazy, as people are paying more and more and more for growth and just don't care about value anymore, which somewhat makes sense in a very low interest rate world.
Itai, what's the technical definition if somebody asked what is the difference between growth and value?
So a growth company is just a company that grows its revenue faster. And a value company is a company that doesn't necessarily have a lot of room for growth because it already has an established market and an established business line. So I guess the easiest way to think about it would be Coca-Cola versus Amazon.
Mm-hmm.
Even though now Amazon, you could argue that is
established.
The end of its growth phase, but they're always finding a way to drastically increase it. Like now they announced that they're going to get into the pharma business. So they keep finding new ways to extract more revenue. So fastest revenue growers here are trading at and this is within the S&P 500. So I'll make it clear. If you break the S&P 500 into two groups, the fastest revenue growers are trading at 4 times their price to sales, with under 1 time for the slowest revenue growers, even though they may have a stable business. And the biggest example of this is that Elon Musk is now the second richest person in the world. He's added $100 billion to his net worth this year alone. And Tesla's market cap is now greater than that of Berkshire Hathaway. I don't know what you guys think of that, but that's just mind blowing to me.
Yeah, it's absolutely crazy. I mean, so what the heck is the explanation for why there's been such a great divergence between growth and value, and what does that mean to like our portfolios in the long run?
Well, I think what it means is when you have a period of massive liquidity injection and very low interest rates, money essentially becomes really, really cheap, and hot money just chases whatever it is that has momentum. And especially Robinhood, I think, had a huge impact on Tesla stock this year. And also keep in mind that the fundamentals of Tesla were not great for quite some time, which attracted a lot of short sellers, a lot of smart money, hedge fund managers, etc. David Einhorn's one example, saying this doesn't make any sense, I'm going to short the stock, whatever. Then people keep buying it. Those shorts get squeezed. They're forced to buy it. They're forced to buy it. And it creates this feedback loop that eventually causes the stock to crash upwards. Does it make sense that Tesla's market cap is greater than Berkshire? Probably not. But remember that John Maynard Keynes said that the market can stay irrational longer than you can stay solvent. So this is by no means a recommendation to short this thing, as you could have done it, multiple times and have gotten crushed. So this is just an anecdote of how the market is right now.
Cool. Itai, do you want to pause there for a second? And let's just ask everybody out there, our favorite people, are there any questions so far from what you guys are all seeing?
I guess my question is, I mean, this is a nutty chart, but stocks are worth whatever anybody's going to pay for them, and this is all looking very bubblicious. And the comment about markets can stay irrational longer than you can stay solvent is absolutely true. But I guess Itai, give us a thought, if you would, on what the bubbles would be and where they are and what might unplug them. What are the unknowns we'd have to be thinking about? Kind of the black swans that you're thinking about when you watch the market.
It's a really good question, and it actually leads me to the second topic. Is there are signs of irrationality and some kind of toppiness that I'm going to present soon. But at the same time, the biggest caveat to that is what the central banks are doing and have done in the past and are accelerating what they're doing. I honestly believe that the thing that can make this whole thing blow up is a sudden increase in interest rates, which will force central banks to just stop what they're doing. And the way that would happen is most likely if we get inflation, which is funny because that's what they're after.
But you're talking about not asset price inflation. You're talking about the inflation of this can of soda.
I'm talking about CPI, Main Street inflation. That will force the central banks to stop printing and raise interest rates.
Okay, cool. So we'll cover that, and Tony, we'll dig in on that. And there was just one more question that came in from Kevin, which is, how do you compare what's happening now to the Tronics boom in the 60s with tech trading at the current multiples they are?
In the 60s.
In the 60s.
Yeah, that's tough to compare. I don't have as much data in the 60s, but I can talk about the 90s.
Yeah, well, we can do that, and then you can always circle up with him later. So I'll let you continue on with what you're doing, all right?
Okay, sounds good. So here is a little bit of what I talked about, some kind of risks that the market does. So it's very difficult to predict a crash or quote unquote, the market dropping, etc. But what you can do is identify times in which the market is more susceptible to a crash. So the way I like to think about it is, let's say you're driving a car and you're in blue skies, middle of the day, perfect weather, etc. Your likelihood of getting into an accident is lower. It could always happen, but it's just a lower likelihood. But sometimes you're driving in rainy conditions and in the dark, and you don't see anything and it's very windy, yeah, sure, it doesn't mean you're going to get into an accident, but the likelihood of something happening is increasing. So that's the way I like to think about the market in the same way. And you can look at sentiment as one indicator. So here to the left, this is one sentiment indicator that shows that sentiment right now is really, really bullish. Now, before the Fed bought everything, the idea of sentiment being bullish means that, look, if everybody already bought stocks because they believe that stocks are going to go up, we're not left with many marginal buyers to keep pushing prices higher, which is why over optimism and too much bullishness is actually bearish. And on the right side, this is the depth of the market. So what is the depth of the market is how the book of the S&P 500 lines up, meaning how, if you want to exercise a buy order or a sell order, how much depth does the market have at the spot market to support that? And the current depth of the market is some of the lowest ever seen, which is another way of saying liquidity in the market is just not very good right now. So if you did have a situation where you had some kind of margin selling or something hitting the market, it could go down very quickly just because the liquidity is not there and there's less active trading going on.
So you're basically saying, I want to make sure I understand that right, because that was kind of interesting. Maybe one of these like black swan events could happen if, in the event that all of a sudden there's a drawdown, somebody has a margin call, they're forced to sell. The book, there's only a small amount of volume at each price level. So if somebody has a big position that they need to close out and they had to do a lot of selling, that could really tank things very fast.
Right. So the current liquidity in what's available. So for example, there are some periods where liquidity is so abundant in the market trading that even if you put a big sell order, it doesn't necessarily going to tank the market all at once. So it's something that, you know, you could follow. That's out of Goldman Sachs research. So this is another interesting thing, the put to call ratio that I like to look at as well, just to show how hedged the market is. So another thing to note is as this ratio goes higher here into these peaks, that means that there's more put activity, more people buying puts. When this goes lower, more people are buying calls, less people are buying puts. There's less activity on the put side. Puts, of course, is either downside speculation or protection. Calls is upside speculation or protection. Normally, you get these spikes during the peaks of a drawdown or a drop in the market. You know, people buy fire insurance while their house is on fire because that's what's happening right now. Early in the year, for example, here in February, March, that ratio peaked as the market bottomed and has reduced since. So it's another way to say, look, nobody's really buying puts right now because the market's doing nothing but going up for a few months now. Sentiment has completely moved away from COVID to there's a vaccine, the election's over, everything is completely fine. And, you know, if there was some kind of black swan that hits the market right now, more people are likely to sell for the reason that they just don't own put protection. Normally, the best time to buy put protection is when nobody else is buying it, not when everybody's trying to buy.
That leads to a great question right now for everybody that's sitting here that's watched this big run up and saying, hey, everybody's really bullish about the future. Sentiment's high. The put to call ratio is as low as it's been. All these indicators are saying that everything's good. And we know that, you know, things tend to go the other way. Is now a decent time to consider that type of put protection or downside protection in a portfolio?
Right. Yeah, absolutely. For people that have stock exposure, now is not a bad time to buy some, as the rest of the market is not buying it. And even though the VIX is relatively higher to history, just given the ratio and sentiment readings, you know, buying some protection 6 to 8 months out is not a bad idea.
How does that chart relate to the VIX right now or over time?
So it doesn't necessarily correlate to VIX levels, but it correlates to VIX tops and bottoms a little bit. Okay. So again, this is another measurement of bullish sentiment. The AAII sentiment indicator goes to a few thousand financial advisors, just to show that financial advisors don't necessarily know what's happening. They have 3 different ways of answering to this. Are you bullish? Are you bearish? And are you neutral? A lot of times 40% are neutral, 30 some percent are bullish, 20% are bearish. That's kind of a normal read. When it gets over 45, 42% bulls, it sometimes shows excessive sentiment. So we can see here in the past, this high reading there led to some kind of market top. Very high readings here before COVID. And look at this huge spike. I've actually never seen it go from 35, 40% to now 56% so quickly. I think the vaccine news probably had something to do with that. Okay, so again, the only caveat to everything I just said is that we're seeing the most unprecedented monetary stimulus and essentially money printing, quantitative easing the world's ever seen. And this is not, this is truly massive. I think this is not discussed enough at all. So in December of 19, we had 16.5 trillion in the balance sheet of the 4 major central banks. And we are already at 25 trillion. And the projected growth by December of 2022 is almost 30 trillion. And that's 29% of GDP in a very short period of time.
You want to tell Jerome Powell what my bank account and routing information is, and just siphon a little bit more off that way?
Or Janet Yellen, I hear she's making a comeback.
There we go. It's QE till the system breaks, I guess.
So let's break this QE into the 2021 numbers, because I want everybody to understand what's going on. So in yellow is the growth, as monthly growth in percentage of the current balance sheet. And the blue is showing monthly growth as percentage of GDP for that area. So the Fed for 2021 is going to print essentially 0.6% of GDP every single month, which is insane. The ECB is going to do 0.9%, almost a full percent of GDP. And I'm talking about areas that don't grow more than 1 or 2% GDP per year, but that obviously doesn't matter anymore. So as I talked about, the full adaptation of the modern monetary theory.
Now, if you go back, one of the things is we all sit here and say, hey, this is crazy what our Fed is doing. But the takeaway that I'm getting from here is that we're just as bad as everybody else, and in some cases we're not even the worst.
Yeah, we're kind of in the middle. So it's a race to the bottom between all the fiat currencies right now. And let's see actually.
Can I ask you one more question? So one of the previous calls, what we talked about is when there's a rise in deficit spending, one of the assets that people really go into heavily is gold, and we saw a big gold run up for a while. I've noticed that gold is kind of decreased slightly recently. Knowing that all this printing is going on, like, what do you think's going on with gold right now?
That's literally my last couple of slides.
All right. I got there too early. I'm sorry.
No worries. So I just wanted to look real quick into how QE has performed so far. Because in 2009, when traders saw what was happening with QE and all the stuff that was going on, they were sure that inflation is going to come right away, but they were all wrong. CPI, actual economy inflation, never happened. And it's been 11 years, and now we're seeing QE exploding. And let's look real quick into the real economy prices, wherein it's GDP or wages versus the asset prices. And asset prices, especially here at the S&P 500, have gone up significantly more than the real economy. And that's because of the mechanics of QE, because QE helps the financial system much more than it helps the real economy, because at the end of the day, it helps the supply side. It's a sort of supply side economics. It doesn't boost aggregate demand at all.
So then what do you make of commodity prices in this whole time going negative? Like, what does that actually tell you about the world that we're in?
So the deflationary world, it's actually funny because we have asset price inflation, but we have a deflationary real economy world to a degree, or there's very, very strong deflationary forces. And a lot of it has to do with two main things: demographics We're seeing aging baby boomers, and the birth rates of the entire Western world are under 2.1, which is the population replacement rate. And the second is technology, which is heavily deflationary. Like, just take into account Amazon, right? How many jobs did Amazon create versus destroy?
Yeah, that's fair.
So didn't they add about 427,000 jobs this year at Amazon?
And how many were taken away?
Oh, a bunch more will be when JCPenney finally goes under. You can count whatever amount of people they have there as the casualties.
So the real question is, are we going to go into any type of real inflation soon? Because a lot of people ask me that. So all this QE, does that mean we're going to get real inflation? And just looking into that, I wanted to talk about this topic that I found is really interesting. So China is moving towards a digital yuan. Last month, this was from CNBC, I found this article, October 12th. China handed out $1.5 million of digital yuan that they gave by a lottery to random people in, I think it was in Shenzhen. And the winners had to download digital yuan app, which is kind of like a wallet for those of us who trade cryptos. And they were given 200 worth of digital yuan, and they were able to spend it with 3,000 different retailers and buy goods, and it even worked at Alipay and things like that. So the main idea here is not just to test the technology. I actually think everybody knows that technology works and has been, has worked with Bitcoin and other currencies like that. They want to see whether or not they can use this as a way to boost aggregate demand, which is what central banks have failed to do so far. So I thought that was really interesting, thinking about inflation. So China has been working on this digital currency for quite some time, and they're going to roll out their digital yuan pretty soon. So let's talk about the types of money that we currently have. So there's 4 different issuers today: the central banks, commercial banks, private, or no issuer at all. So the easiest way to think about it, a digital non-issuer is a cryptocurrency or a Bitcoin. A physical will be gold. Now, a private issuer, you'd have a payment provider as an account base, right? Then you have the stable coins, and the physical is a prepaid card, even though it's not exactly. Now, everything you know is a bank deposit, checks, wires, debit cards, what have you. That's not digital dollars. You may think it is, but it's not, because it's an account based, and it's actually sitting in a bank, and it's held by a bank, and it's overseen by a bank. So it's not digital dollars. It's not digital euros. It's an asset and a liability of a bank. It doesn't actually belong to you. That's why you have FDIC insurance, because the money that you think is in the bank is not really there for you. So having a digital yuan is the first token-based digital money that belongs to that government, that is completely backed by the government and passes through the bank system completely. So you have the central bank money, you have the account base, which is central bank reserve, balance sheet. That's what the Fed has. That's how QE happens. Now, the digital yuan, digital dollar, digital euro, whatever it is, would be a digital token base, where the physical version is just cash. And what's interesting is that the world is moving away from the SWIFT system into that system. So we'll talk about that in a second.
Itai, I think there was some pretty big implications of that. Do you want to take some questions super quick?
Sure.
No, none of you want to know how potentially the government's just going to go right into your pocket and oversee and freeze everything that you have even faster than they already can? I mean, what big problems do you see for all of us if this actually comes to fruition?
Well, I think that this is a way. This is eventually a part of the plan to move away from cash altogether, and a way for the government to eventually implement UBI and helicopter money. I think that's the next part of the. They see that they've done QE now long enough to know that it doesn't necessarily work, and it increases inequality. So this may be a way to create a type of UBI or helicopter money, because they've been talking about it and writing papers about it for years. It's not a secret.
Do you want to just quickly hit on what UBI is and helicopter money?
Yeah, it's the idea of basically the government just handing out cash to the citizens directly. There are a lot of problems with that in the past, primarily because you don't necessarily know who you're sending it to or directly to people, et cetera. But the idea of what China just did, having people directly have their, their wallet that's directly linked, they know everything about everything you do, and then they can just drop digital version of the currency directly there. Essentially, you don't need the bank at all, and that's something that the governments want to have. So they're taking the idea from cryptocurrencies and using their national currency to assert more control over it.
Got it. Cool.
So global debt, let's talk about that for a second. So this is global debt going back to 2013. Given everything the governments are doing and the QE programs, in 2020, debt to GDP ratio has gone into about 370%, I want to say, and $272 trillion. So 2020 alone saw $21 trillion fiscal and monetary stimulus. The US deficit is second only to World War II today. Again, 365% debt to GDP by year end, and of course, the lowest interest rate level in 5,000 years of recorded human history. So I think we will see the loss of central bank independence as the central banks become political pressures, and the UBI and helicopter money I talked about. So this is essentially the stealth implementation of the modern monetary theory. So the last thing that needs to happen for this to actually happen is, I don't know if y'all are familiar with the SWIFT system for bank transactions. The global system is known as SWIFT, which is how you move payments between one country and another. And every bank around the world has a specific SWIFT code that needs to be verified so transactions can happen. This is a way, for example, of how there are people sitting in the FBI and the NSA that were able to track Osama bin Laden and people like that through SWIFT transactions of money going from one place to the next. And this is how you're able to track it. So in Europe, you have the target system. In the US, you have the Fedwire system. So the idea is we're moving to the ISO system from SWIFT, and the ISO system will enable digital currencies for those nation states. So imagine the governments will now literally be able to track very effectively all banking transactions and monetary transaction going around the entire world, as Europe is going into the ISO 21 and England in 22. And the US, I think, will go into in between 21 and 22 as well. And for 4 years during 2022 until 2025, there will be a double SWIFT and ISO system. But after that, we're all going to live in a digital world.
Itai, one of the questions that I got privately was, well, you've done a good job now scaring us. So what the hell do we do?
You know, my job is to make you aware of the situation, right? Because this is stuff that you normally don't hear about in the news so much, but all this information is publicly available if you're just looking at it. You know, I think this is just a way for government to exercise more control, and in the next crisis potentially implement helicopter money drops and things like that. So it doesn't necessarily mean things are going to get worse, but this is just something to be aware of.
So better question then, since you avoided answering, is knowing what you know about the system now, how are you approaching investing your own personal money with all this type of stuff happening in mind, and why?
That's why I give a more, I put more money in alternative investments like multifamily housing, realizing more people the QE policies are causing income inequality to increase and increase the demand for workforce housing. So I invest heavily in that. And also the main idea is I don't want all my eggs in one basket. So I don't want to have too much public market exposure. And even if I do, I basically hedge the risk. So I think that the moral of the story is you have to be more diversified than just the traditional public and private markets, and also be aware that, you know, you could potentially see your base currency being devalued. So you need to basically accommodate that. So I think, you know, digital assets have worked to do that. Gold has worked to do that. So those are good diversifiers for sure.
All right, thank you.
So talking about that, just something kind of interesting to note. Why is it so important for the Fed to maintain price stability in the stock market? Is because financial assets are now 6.2 times the size of GDP for the US. So, you know, in the past, going all the way into the 90s, they traded around 3 times, 300%. But now financial assets are so big compared to GDP, we've become a financialized country. And COVID actually accelerated that because we've seen massive monetary injections, but with, you know, the finance side of the economy and big tech absorbing the majority of it, that did just become a bigger and bigger sector. Okay, so that's kind of why we have a third Fed mandate of pumping up the stock markets. Wanted to talk a little bit about the budget deficits that we're seeing. So when I started a call, I said, I think it was Tony that talked about the QE, and I said, look, the amount of money they're actually creating now, it's insane, and it's literally never been anything remotely close to this. So here's October 2020 budget deficit. So that's already going to budget year 2021, and here's 2020 compared to all other years. So the government's literally spent well beyond anything remotely close to anything that happened so far as that, obviously due to COVID and the shutdowns, etc. And if anybody's interested in what October 2020 looks like, the government brought in $238 billion and spent $522 billion and had a deficit of $284 billion. But at the same time, interest was $32 billion. So even at the current interest rate environment, 32 over 238 is 13%. So even with this situation of interest rates being so low, 13% went to spend on net interest, which at this point, you're probably borrowing the money to pay the interest. So you're actually paying it with borrowed money, right?
I mean, this graph is like absolutely incredible. To me, this is like the first time I think I really understood the magnitude of what's happening here. Because, you know, I'm looking at this and our total cash receipts in are 236, and just what we're spending on health benefits and veteran benefits alone, I mean, that puts us, including Medicare, almost at like 200 billion. This is not sustainable.
Jeremy, you apparently never lived off of a payday loan.
Yes, that is true. I haven't, although I went through quite a long period of time of living on almost nothing. That startup world in the beginning is pretty brutal.
Your car is your credit, just to let you know that.
But you know, what's funny is we have all this talk about raising corporate income tax by like 5% or something like that from 28, 22. Like, it's barely anything. And, you know, all this fuss over like such a tiny amount of income when you're spending so much beyond that. It's actually hilarious to me. Okay. So at the same time, this is October here. So the amount of interest the federal government actually pays has pretty much never been lower, given the amount of spending that we're doing. So is there an incentive to keep interest rate low for a long time? Definitely, because otherwise, how the heck are they going to pay it? At these interest rate levels, they're spending 13% of what's coming in on interest. So how are we going to be able to sustain a higher interest rate environment? I just don't see it coming. And something interesting too that I note that I found. So 2020 was kind of interesting because the treasuries actually issued $1.6 trillion of cash of treasuries that were not deployed because the Congress couldn't reach an agreement over a stimulus package. And based on what the 2019 debt ceiling, in August 1st, there couldn't be more than 200 billion in the treasury account, which means the treasury has to spend 1.3 trillion over the coming 8 months. And that's how it looks like based on Morgan Stanley, which means that on top of everything the Fed is doing, the Treasury is going to spend $1.3 trillion in the next 8 months, which is going to cause another massive surge of liquidity.
But what mandate is there that says that they absolutely have to spend this?
That's based on the debt ceiling, and that's law. So they apparently by August 1st, they can't have over 200 billion in there, because look how many billions they're actually sitting on based on the issuance they've already done. And what's interesting is that the amount of supply coming from the Treasury. So again, the way it works is the Treasury Department issue bonds, and then in the QE world, the Fed buys them, because who else is going to buy a 10-year bond at 0.8%, right? Not many people want to do that. Which means that the Fed will have to double the size of QE next year to meet up with the expected supply that is going to come in. And that tells me the Fed is going to need some kind of excuse to double the QE next year, on top of what crazy amount of QE is already happening.
Do you have any idea how the future QE plans are for the US versus some of the other countries?
Yeah, everybody's expanding QE drastically into 2021. So you see, I already showed at the beginning of the chart that we're issuing 0.6% of GDP every month for 2021. So that's back to your goal chart. Just, for traders purposes, the 200-day moving average, kind of like the average of price over 200 days. Nothing set in stone, but during an uptrend, it could be an interesting place to get into gold, just to answer your question. And this is gold's relationship to debt in the past. This is the gold price in red versus the total federal debt. It's kind of interesting because here in the 70s and here in 2011, gold moved faster than the pace of debt, and now they're pretty much in sync. So as it moved faster, it came back to where it was. And this is the federal deficit versus gold prices. Also a pretty interesting relationship. And that's about it. Just leaving you with those thoughts.
Just left us with a golden nugget at the end of that of information. Thank you.
With that much QE expected, and so many other countries pushing out debt, wouldn't the natural order of things for interest rates to go up a little bit, just because you got so much debt that's being flown out there and they've got to get people to buy it, or just the country's just going to keep the local feds or central banks are going to keep buying it?
In a normal world, you'd be 100% right. But the problem is that when you're issuing your own demand, then what happens with interest rates, right? They're like a seesaw. So as the price goes up, yields go down. So if they buy it and buy it and buy it, that's what's pushing yields lower. So it's funny because they're creating more money, but the money they're using is pushing pushing interest rate lower.
And that's what you're talking about, the modern monetary policy driving everything, basically.
Yeah. So that's the idea, is if you can create your own demand for your bonds, your borrowing costs should be zero, and you can issue as much money as you want to do whatever you want. So I think the one biggest risk to all of this is if suddenly real world inflation comes in and they have to stop it, then we've built ourselves a mountain of debt 4 times greater than the global economy, and who knows how that ends.